Next up, we will be sharing on how to boost your retirement income using annuity and the 3 generations plans. Learn how annuity and 3 generations plans can boost your retirement to provide for better quality of life and even take care of your loved ones after one's passing. Does policy financing improve yields? And how can plans such as 3G savings and annuity plans be used as estate planning tools? We will be inviting Mr. Salim Amin, CEO of Avallis Financial Pte Ltd, to share with us more about all these topics. Mr. Salim has been associated with the financial services industry for more than 35 years, advising individuals and corporations in the areas of investments and financial planning. His views on financial planning have been reflected in various financial journals and in the media too. He was the past president of the Association of Financial Advisors in Singapore. So let's invite Mr. Salim, please.
Morning, ladies and gentlemen. Welcome to my session, and thank you very much for tuning in. I will be covering the topic on how to boost your retirement income through the retirement plans, or commonly known as annuities. Right, and so before I proceed with my presentation, I think most of us are kind of concerned what this phase is going to go through, how this phase is going to go through for them, because retirement really is quite a big thing right now in Singapore as we talk about it at this point in time. And it is also the stage which a lot of us are looking forward to, with hopefully excitement and sometimes anxiety. But of course, at the end of the day, what we are looking forward is a stage of our life whereby we are no longer driven by the kind of challenges that we have to face at this point in time, meeting the responsibilities of corporations, or even responsibilities of looking after children. Right, so let me just bring you to, let's talk a little bit more about what retirement is all about. Okay, so what is retirement in future for us? For the large number of us, obviously we are looking towards spending more time with our loved one, and our spouse is definitely the one that we want to spend more time during retirement. And of course, retirement today is not just about living and surviving, it's about an active lifestyle that we want to go through. And some of us who want to see the world, some of us want to travel a lot more, some of us want to do a lot more things that we've not done before in our lives. And for some of us, we want to push it a little further. You want to do the things you've not done before, maybe even doing some form of exercises that you have never tried before in your younger days. And of course, for some of us, retirement is also working, and this is working out of pleasure, and not so much because we needed the income to keep ourselves going during retirement. So the topics of my discussion really will focus on these areas as we are to align with the topic of my presentation. When can I retire? What do I need when I retire, and for how long? Illustration of the retirement solutions, and how does retirement plan or annuity work, and what to watch out in your retirement solution. So first, when can I retire? Now, some people will think it is just the traditional age-dependent concept where you reach a certain age and therefore you have to retire. Or sometimes you can think about the fact that you don't need to look after your children, and once your responsibilities are done, well, that's when you can retire. Or for some people, it could be due to health reason, and yet for some, it's driven by the employer. But whether it is traditional, whether it is age-dependent, time frame, or driven by health, I think the acid test is really this question. That is, when I can afford not to earn an income, and yet be able to pay for my expenses to do the things that I want to do for the rest of my life. And if you can achieve that, essentially, you can retire, right? Next question, what do I need to do? What do I need when I retire, and for how long? Okay. Now, the first thing that you have to understand is that retirement is not going to be very much different from your active life when you're working. Okay. So you still need your continuous income, your cash flows to pay for retirement expenses. Now, you don't need a lump sum, but you need a continuous income throughout. as against the traditional thought that the lump sum coming in for retirement is good. Actually, it works to your disadvantage. What you want is to be able to continuously have the income to pay for your expenses. Secondly, your expenses will be affected by inflation, okay, which is your increase in living costs. Thirdly, you will need cash flow till you are no longer here. That means throughout your life expectancy. Some may argue that the life expectancy could be 85, 86, 87 as of today, but I want you to look a little further, because by the time you and I retire, it could be maybe 20 to 30 years down the road. Mortality would have improved, all right? And we might be looking at the age of 90 or even beyond that, okay? And of course, finally, the changing expenditure pattern that we will face during retirement as we grow older. Because at various stages of our retirement, we may not be doing the same thing that we've been doing. Right? So let's just take a look at how it will look like, okay, when we retire. So assuming that you are 45 years old and you need a monthly income based on today's living needs of $3,000 a month and an inflation rate of 3%, and your retirement age is 65. Okay, how does that look when you're 65? Well, when you're 65, based on inflation and the living expenses, your real dollar, your inflated expenditure would be $5,418 per month instead of $3,000. And that's just based on 3% inflation for the next 20 years. And this will continue to increase. Looking at this chart, you can see that at 65, your living expenses starting at $65,000 per year, and it will gradually go up to $132,000 by the time you're 90. Okay, in total, you're probably spending about $2.5 million in terms of expenditure that you have to bear with. Now, bear in mind one thing, as I said earlier, that your lifestyle during retirement may not be the same. So we go through phases in our retirement, and let's explore how does that affect our expenditure pattern, right? So in the first stage, there is the active phase. This is the time when you just retire. And what you like to do is do what you've been always wanting to do. You like to travel, outdoor activities, and you could be spending between 85% to even 150% of your current expenditure. So you could even be spending more than what you're currently spending, right? Or you could be spending just about 85%. So that's just the average range of expenditure based on your income when you retire. Second stage is the passive phase. This is the stage where your pace of life would sort of slow down a little bit, okay? Slower pace of activities, more indoor-driven activities, hobbies, more family-oriented, and by and large, your expenditure pattern will be about 75 to 100% of your retirement expenses when you first retire, okay? And when you come to the third stage, which we call the reliance stage, this is when you are talking about consolidation of time, you want to focus on sustenance of health level, and really a lot more passive than the previous stage. And you will probably spend between 50 to 75% of your retirement expense from the beginning of time. Okay, so these are the three phases that we all will go through during retirement. As to how long each phase will last for various individuals really depends on the health and the personal preference, and of course the income that's available for the person to do what he wants to do. So by incorporating this changing lifestyle that we talk about into your living expense on retirement, here's what it's going to look like. Okay, the one in the bar in blue basically would be the earlier bar that you saw in terms of expenditure. The one in orange will be the one with the changing spending pattern incorporated inside. Right? And you can see from here that your expenditure on a regular basis throughout your years in retirement will sort of tone down a little bit more moderated because of the changing spending pattern. So instead of spending about $2.4 million in total expenditure, you are spending only about $1.95 million, probably almost $500,000 less, just by but understanding the fact that we do have our expenditure change over our lifetime during retirement. So how does that look like? And what kind of solutions do we have for retirement? Now, generally speaking, there are these possible retirement solutions that most of us are acquainted with. One is bank deposits, something which a lot of retirees like to have because it makes them feel safe, makes them feel that they've got money for retirement. Okay, but too much money in a bank deposit doesn't help at all. Okay, because bank deposits generally don't give very good interest rates. And we know that in most cases, the inflation rates are usually higher than the interest rates. And if you put too much money in a bank deposit, you're basically allowing it to reduce, to eat into your savings. Then, of course, in Singapore, we have CPF Life, which is a government scheme. This is good because it's aligned to our retirement expenditure, right? So it gives us a regular income throughout the rest of our life. And, of course, there's also bonds that some people would buy for the purpose of retirement. It pays a certain level of dividends to us, but bear in mind one thing, that when you buy a bond, you obviously behind a huge principal amount and you leave off the dividends. And bonds are not always possible to be bought in small bite sizes. Okay? And now, of course, you have rental income from real estate. Somewhat the same as a bond, in the sense that it also pays a rental income, and you leave behind a fairly large value on death. Right? So both bonds and real estate usually pays a lot less in terms of the income, because a large portion of it is left for the estate. Okay? And of course, you have unit trusts, stocks and shares that people are willing to venture in, to take some risk in hope that they'll get a better returns on investments. And lastly, retirement plan, or what we would term commonly as annuities. This is a plan which many people are not quite well acquainted yet at this point in time. Though I must say this is not a new plan, it's been around for decades in Singapore, but it's only been used extensively in recent times because insurance companies have started to customize annuity plans to fit into the retirement needs of individuals of late. And so it's working out pretty well. You'll see an illustration at a later stage of my presentation. Okay, so let's look at a simple example of the earlier case where the man decided that he wants to put in some investments for retirement, or rather save for his retirement using endowment schemes, bank deposits, shares and unit trusts, which is very typical for Singaporeans. And we'll say that he decided to put in about $10,000 of savings into endowment on a yearly basis, set aside $7,050 for bank deposits, buys into share on a regular basis, as well as unit trusts. And this is accumulated all the way until he retires at the age of 65. So in total, he would have saved about $573,000 in all for his retirement. And let's look at how this works out for his retirement situation. Okay. Now the one in red, or rather orange, is the annual living expenses that he has to bear with. And we have the small tiny one in green, that's really the CPF Life payout. Now, looking at what he has in terms of his retirement assets that he has accumulated, and based on the investment rates of the various asset classes that he invested in, this is how it will look like, how his retirement assets will reduce over time as he begins to use it for his retirement needs. And by the time he's 80 years old, he would have run dry, right? So this is a scenario that we commonly see in our country. And of course, there could be ways and means that we can tweak this. Now, let's now incorporate retirement plans or annuity into the retirement solutions. And instead of having the endowment scheme, which most people traditionally buy for retirement, we have decided to substitute that with 3 retirement plans bought at different times, 45, 50, and 55. We decided to reduce the bank deposits to $3,000 a year, and we still maintain the unit trust investment of $8,100. But we removed the share investment because we thought it might be a little risky. Okay? So with this sort of plan that we put in place, and we have worked it out such that the total amount of investment remains the same as $573,000. Okay, we'll see how this really works out for our clients, right? Now, but before I show you that, maybe I will just explain to you a little bit about what retirement plans really are and how it actually works. Okay. So first, retirement plans are simply annuities which works to accumulate a sum of money on a regular basis before you retire, all right, so that it will be used to pay off a stream of income throughout the rest of your life as you plan for it. Okay, so what you do is you decide on how much you want to save per annum, number one. Okay, number two, you could decide whether it is on a lump sum basis, okay, or it could be over a period of time, 10 or 15 years, really up to you, okay? And of course, you can plan for an annual income based on a designated age of payout. So you could have a payout age starting at 60, 65, or even 70. And for how long you want to be paid, you can decide that as well. It could be for 15 years, 20 years, in some cases even for the lifetime. Okay? Now, you do not need to buy all your annuities all at one go. It could be bought over a period of time, like in the example that I shown earlier. And in most cases, the ROI, the returns on investments, will be about 3 to 3.5%. Okay, pretty conservative. And the income from the annuity has both the guaranteed and non-guaranteed portion. Non-guaranteed portion because the insurance company cannot fully guarantees the income, and that's the guaranteed. The non-guaranteed portion is the one that forms the 3 to 3.5% per annum returns on investments. And of course, you could also choose to diversify your annuity plans with several companies instead of one. Okay, so generally, this is how annuities in Singapore or retirement plans work. So now let's look at how the annuity plans that we have decided, or the retirement plans that we decided to incorporate in our example, worked out in terms of its retirement expenses. Okay, now here's how it looks like. In the same situation, you will find that your retirement assets available is reduced from almost $800,000 to $300,000. You have reduced the exposure of your assets as a lump sum. And that portion has actually gone into an annuity scheme or retirement plan that pays out the regular income to expense off your annual living expenses. So you live much less exposed as an asset, okay, in the other forms of investments. Okay. And you can see from this example that your funds only run out at the age of 85. Given the same amount of investments that you put in the earlier example, okay, and it's just a tweak of the plans that we have incorporated earlier, you're now able to increase your funds period for another 5 more years. Now, in which case, for this example, it's still not sufficient for the person to ensure that he has sufficient fund for retirement. So probably in this example, he needs to add in another 1 or 2 more retirement plans. But what we are trying to show here is that the retirement plan actually can help to align the person's expenses with the plans. Okay? And why does retirement plan work so well? Well, first, it provides a regular stream of income that is aligned to retirement needs. Okay? Simply because on retirement, we will still need to continuously spend money. But we don't need to spend all at one go. Right? So we don't need a lump sum, but instead we need a regular stream of income, which means more of those income can be kept the insurance company earning better returns than leaving it exposed out there. Secondly, we reduce investment risk and complexity of managing the plan. Now, most of us at the retirement age do not want to take unnecessary investment risk, and we may not be in a position to be able to decide what's the best stocks or what's the best investment to do. And even if we realize that we do not want to take too much risk because we're no longer able to work, and whatever we have is what we have. And we need to make sure that it is securely invested to reduce the risk of loss. Thirdly, it offers a more peaceful and less stressful retirement. Now, you don't want at retirement to be wondering which investment to be investing in to continue to be able to fund your retirement, to give you that sort of income to boost your retirement needs. You don't want all those stressful situations. You could, when at 65, still make some decent investment decision, but at 70, could you do the same? At 75, could you do the same? At 80, could you do the same? Now, I deal with people who are all in this age group. Okay, and I see how people have changed from somebody who's very apt in investments all the way to a point where they say, I do not want to invest anymore. Right? So we need to understand that the stage of life that we go through in retirement, and that sort of change the perspective in the way we look at investment risks. And of course, life income payout can be used even for up to 3 generations. And that's for some of us who realize that we have a little bit more than what we would be able to leave behind for ourselves. We can actually plan a life annuity income that is able to cater for 2-3 generations. Okay, and simply by doing some form of assignment and the will and the trust. Let me just illustrate that to you in the next slide. Okay, first, this is what we call a 3G plan, okay, using an annuity. So you take up a life annuity on the life of a child. A life annuity is also a retirement plan, but it pays out on life income, okay, with the father as a proposer. And then you assign it to the grandfather. So the grandfather owns the policy, right? The policy is taken up by the father on the life of the child. But of course, the grandfather in this case funds the policy. Right? And that's the reason why the policy is assigned back to the grandfather. Okay. Next, have a will or a trust done to transfer the life annuity to the father on the death of the grandfather. Right? So while all of them are alive, right, the grandfather will continue to receive the annuity income, okay, until such time that he passes on, okay, his will or the trust is done, will then transfer the life annuity that he owns to his son, which is the father of the child who bought the policy, right? That's on the death of the grandfather. And of course, the third thing to do is to include in the father's will to transfer the life annuity back to the child on his death. Now, this is optional if a trust was done by the grandfather to have that effected in the plan. So in essence, a plan is done that benefits 3 generations. So instead of giving a lump sum to the child, a lump sum to the grandchild, what a man could do, right, is to have an investment done to benefit himself first, and on his passing to his son, and on his son's passing to the grandson, or the daughter or the granddaughter. Okay? So this essentially is how the 3G plans actually work. Now, let's talk a little bit about the mistakes to avoid in retirement planning. Okay, this is important so that we do not want to get into some situation that we would regret, because in retirement there's no chance for turning back. First, leveraging your retirement plans. I hear a lot about leveraging insurance policy, taking a loan or insurance policy to boost your income. Does it work? Yes and no, but think about it. Do you want a retirement plan that you have by the time you're 70 or 75 to be saddled with a loan, all right, that has a possibility that one day, should the interest rates goes up too high and the bonus of the insurance company comes down, okay, have a situation that you might have lower and lower or reduced amount of income to live with, or in even some extreme situation, no income because you have to pay off the interest. And worst of all, when that time happens, you may have to even surrender the plan, okay, and forgo your retirement plan. So this is rather tricky, and anyone who wants to leverage your retirement plan using a loan really should think twice and work out the mechanics as to whether this is the risk that you can take. If it can't, then obviously my recommendation to you is not to leverage it. Okay? Secondly, plan to leave something behind when you don't have enough for yourself. This is somewhat the Asian mentality. You know, you want to make sure that your children will receive something when you pass on, without regards to whether you actually would have enough for yourself. Now, I would strongly encourage every one of you to think for yourself first before you think for the next generation. They will also have a hard time thinking for you, okay, given the current situation, the generations that we're looking forward to. Okay? Now, of course, hope for unrealistic investment returns. You can't expect your investment returns to go up sky high when you don't want to take so much risk. Now, if you feel that you don't have enough for retirement, the solution is not to take high-risk investments. That's just getting yourself into trouble. right? It meant that you have to rework your entire expenditure pattern, your savings, and probably even extending your retirement age to make sure that you're able to fund for your retirement needs. And of course, putting all your eggs in one basket, trying to invest in one particular company or one single product is really quite unwise, because you never know, okay, the investment that you have put into would be able to achieve the retirement income that you want to, or whether the returns on investment will really be achievable. So we do encourage you to make sure you spread your investments across a basket of products, and also the various companies that are available for you to consider, right? And of course, think that you can manage your investment for life. Like I said earlier, when you come of age, it's sometimes quite difficult to catch up with the market. Right? And if you want to know how is it like, then for some of us whose parents are still alive, just look at them who are in the 70s and 80s and just ask them some simple investment questions and see how they respond. That's who we are 20 years from now. Okay? And of course, finally, depending on others. Okay, we hope that our children will be able to look after us, but we cannot expect them to be able to finance us for our retirement. I'm not too sure if they expect to be doing that for us, but I think a safeguard for ourselves is to make sure that we can be independent of their financial support. So that essentially brings me to the end of my presentation. I guess I probably have time to answer maybe 2 or 3 questions. No? Okay. So if not, thank you very much for listening in, and have a good day.